Hello everyone, and welcome to this TaxDev event. I think we've got a number of people that have now joined and others are drifting in, so we'll get started. And thank you everyone for joining today. I'm Hazel Granger, a Senior Research Fellow at ODI, and I lead ODI's work on tax and development, including the TaxDev programme. So for those of you who don't know the programme, TaxDev is short for the Centre for Tax Analysis in Developing Countries. TaxDev is a UK aid-funded programme delivered jointly by IFS and ODI, which aims to support more effective tax policy making in low and middle income countries through partnerships with governments and researchers. So we carry out research and applied analysis on tax issues, and currently we work with tax policy units in Ethiopia, Ghana, Uganda and Rwanda. And today we're delighted to present to you some of our work and discuss with you the challenges and opportunities in Africa following the COVID-19 pandemic. COVID-19 has obviously had a profound effect around the world and stretched government resources to the limit in responding to those most affected. And these responses and the rollout of vaccines are now determining how quickly economies can recover. In fact, as countries like here in the UK prepare to reopen, many countries are sadly still in crisis response, and Africa has just recorded its highest number of cases yet. As a result, many lower income countries are facing acute fiscal challenges, and with more limited borrowing opportunities, they need to fund more and more from already diminished domestic resources, while at the same time considering how to kickstart economic growth again. So there are obviously lots of ideas being discussed in forums just like this one about what countries can do and the role of the tax system in that. And today we'll be looking at the fiscal situation for Africa and what this means for fiscal policy opportunities to address the challenges, with a focus on three areas of taxation: motor vehicle taxation, property tax, and the proposed global income tax reforms. So we're going to have 4 presentations on these topics with a short Q&A followed by a panel discussion. And there's lots to cover in quite a short time, so we kindly ask people to stay muted. And if you would like to ask a question to any of the presenters, then please write your questions in the chat as we go along, and we'll be monitoring that. And we'll select some of them to put to the presenters after all 4 presenters have finished speaking. We will also be recording the event for upload later for YouTube for anyone who missed it. So I'm now going to introduce to you our 4 presenters from the TaxDev team at IFS and ODI. We have firstly Ross Warwick, a research economist at the IFS and country programme manager for Ghana. And he'll be talking about the fiscal challenges for Africa. Then we'll go to Vedant Nair, who is a research economist at the IFS. We'll be talking about motor taxes. We also have Ian Steele, an ODI research associate, discussing the global corporate tax. And finally, Anne Brockmeyer, the research director for tax and development at IFS, will be talking about property tax. So without further ado, we'll first go to Ross. If you'd like to share your screen now, please.
Thanks very much, Hazel. And thanks everyone for coming to this event today. As Hazel said, countries in Africa are still facing quite a perilous moment. But on top of the economic and public health challenges of the pandemic, the deterioration in public finances in the region has added to pre-existing trends of rising debt and debt costs. In this presentation, I'll be summarizing findings from a new report that we've released today, which summarizes this fiscal context and then looks to the future to consider the main considerations and policy options for governments in the region that might be considering fiscal consolidation measures in the coming years. And this is a report which is a part of a kind of an informal series of reports that TaxDev researchers have written in the past year and a half about how fiscal policy can respond to COVID-19. And those reports are still relevant for many countries. Previous ones have looked at support and stimulus measures, so please do look at those on our website if you're interested. So I'm going to start today by very briefly summarizing the fiscal context in sub-Saharan Africa. I think it's fair to say that it's a challenging but a varied fiscal outlook across countries. In 2020, the impact of the pandemic deteriorated public finances quite substantially due to a combination of reduced GDP and revenue shortfalls. So overall in the region, real GDP fell by 2% in 2020, and looking further ahead, by 2026, the IMF expects that real GDP will be 6% lower than pre-pandemic forecasts. Combined with revenue shortfalls, average budget deficits in the region increased to 5.8% from 4.3% in the previous year. This is a smaller increase than was seen in high-income countries, and also with a different anatomy of the budget deficit, specifically because of the contribution of revenue shortfalls rather than expenditure increases. As a result of these developments, debt levels and debt servicing costs have increased relative to GDP and revenue in the region, adding to what was already a difficult outlook pre-pandemic. So if we first take a look at gross public debt in sub-Saharan Africa as a share of GDP, this is a weighted average for all sub-Saharan African regions covered in the IMF's Fiscal Monitor database. This dotted line shows the IMF's forecast from October 2019, and we can see that gross public debt did increase quite substantially up to 2019, but then was expected to stabilize thereafter. This solid line then shows the IMF's most recent forecasts, with the difference here giving a rough idea of the impact of the pandemic. And so according to these forecasts, gross public debt was 7 percentage points higher in the region in 2020 than the 2019 forecast, and is expected to remain higher in the coming years, even if stabilizing somewhat. We can also look at debt servicing costs as a share of revenue. And again, if we take the IMF's pre-pandemic forecasts, there had been quite a significant increase in these debt servicing costs in the years preceding the pandemic, although more so before 2016. The most recent forecasts show that in 2020, debt servicing costs spiked at 22% of revenue in the region. And although they're expected to come back down again this year, by the end of the forecast period in 2026, they're now expected to be even higher than that 2020 spike. So overall, it's a difficult fiscal outlook in the region, and forecasts out to 2026 suggest that for some economies in the region, there may be a need for fiscal consolidation measures to improve their fiscal situation. But it's important to recognize that the case for such measures does vary a lot by countries. There's a lot of variation across individual countries in their fiscal outlook. So just to give a sense of that, these are the 4 countries that TaxDev works most closely in. Debt servicing costs as a percentage of revenue shown in 2019, 2020, and 2026. Straight away here, Ghana jumps out as a bit of an outlier, where debt servicing costs are extremely high, above 50% of total government revenue, and expected to stay around that level to the end of the forecast period. Other countries in the region with high debt servicing costs include Nigeria and Kenya, but even Uganda here, where debt servicing costs are above 15% of revenue, and Ethiopia expected to be above 10% by the end of the forecast period. So overall, there's certainly some countries in the region that might need to consider fiscal consolidation measures. Indeed, the IMF and World Bank have say that there's 16 countries in the region at a high risk of debt distress, and 6 countries already in debt distress. And indeed, some countries are already implementing or planning to implement fiscal consolidation measures. So this is not just a theoretical consideration either. So some countries might be considering fiscal consolidation in the region. Others may wish to do so because of the costs of not pursuing that fiscal consolidation in some cases. For instance, the potential crowding out of private investment, or the inability to respond to future shocks. So we next consider what are the main design considerations for such measures. The design of a fiscal consolidation package is really important, because fiscal consolidation, especially in this moment, can be quite costly. So while governments may need to consider these measures, at the same time, they need to be able to combat the pandemic and secure economic recovery. So the goal of any package of fiscal consolidation needs to be to meaningfully improve public finances while minimizing hardship and negative effects on the economy in both the short run and the long term. We consider three main types of design considerations for policymakers. The first is the scale, which is crucially important, but is going to depend a lot on an individual country's fiscal outlook. So I won't spend any time discussing that in detail today. Instead, I'll focus on the main considerations for the timing and composition of consolidation measures. So starting with the timing of fiscal consolidation, we consider three main aspects to this. Firstly is economic conditions. This is really important because there's lots of evidence to suggest that during a downturn, undertaking fiscal consolidation measures can have greater economic damage, both in the short term and also in the long term, because of potential scarring from unemployment, for instance, or foregone investments. So this would suggest that consolidation measures should begin after public health and economic recovery has been secured. Financing conditions might change this, however. Some countries might need to bring forward consolidation measures because of liquidity problems. Others may wish to consider their exposure to future financing conditions because of the profile of their debt maturity, for instance. A final aspect of timing, which is really important, is implementation timelines. This is precisely because consolidation measures can be economically harmful. This makes it really important to implement the right policies which are going to minimize that harm and yield sustainable and efficient revenues and consolidation in the long term. And those policies that might be most feasible in the short term are not necessarily going to be the most desirable. So having a plan for consolidation which takes into account these implementation timelines is crucial. Turning now to the composition of fiscal consolidation, there's a couple of key considerations here. An obvious one is whether to look at the expenditure or the revenue side of the budget. And we think that overall expenditure reductions are likely to be less desirable in most cases. This is for a couple of reasons. Public expenditure is really important for essential services, and especially in a moment like we're in right now, and also for investments which might have very high returns in the future, such as in human capital. In addition, recent empirical work specifically for Africa has suggested that expenditure-led consolidation is both less effective in achieving stated objectives and more economically harmful. So overall, expenditure looks like a less desirable target for consolidation. That's not to say that there are no opportunities here, though. For instance, where fossil fuel subsidies exist, that looks like a prime area for reform. And in some cases, there can be worthwhile reforms in the public sector. For instance, if the public sector wage bill is very large, or in some countries, state-owned enterprises might warrant reform. A second aspect of the composition of measures is about the time horizon. So we distinguish a bit between measures that might be more desirable in the short term and those that might be more desirable in the long term. In the short term, it's particularly important that policies pay attention to potential harmful demand side impacts. And this yields a few useful rules of thumb for policymakers. So for instance, direct tax increases are likely to be preferable to increases in indirect taxes, as the latter might be more likely to shift consumption over time. In the long term, though, policies need to have a greater focus on improving the efficiency of the public finance system, for instance, by targeting externalities or targeting activities which might be particularly unresponsive to taxation. So those are some high-level considerations for designing a package of fiscal consolidation. I want to spend the last few minutes talking about a few concrete policy options which we think reflect these principles. So in the report, we identify a list of policy areas which we think have quite broad appeal across sub-Saharan Africa. It's not an exhaustive list, but we think that these would be suitable in quite a few contexts or worthy of consideration. Mostly on the revenue side, and we distinguish between those, as I said, that might be more suitable in the short term or for temporary revenue raising, and those that have greater potential for long-term or permanent tax revenues. And we'll hear a bit more on a couple of these in subsequent presentations. I think it's also important to say that these longer-term or permanent revenue sources are not just useful for fiscal consolidation, they're also worthwhile in contexts where governments are looking to bolster domestic revenue mobilization more generally. I don't have time to talk about all of these today, but I do just want to talk through our thinking on a couple. So for instance, on the short-term revenue raising options, our focus is on policies which are both implementable in the short term and minimize this impact on aggregate demand. And we think that corporate income tax surcharges fit that bill quite well. Firstly, because they're likely to be administratively feasible. It's just changing a rate of an existing tax in most contexts. Additionally, if temporary, the impact on investment and location decisions of firms which should reap returns many years in the future should be relatively small. In fact, you might even have some firms that bring forward investments if the investment stays profitable and they can claim allowances at a higher tax rate. Of course, this does rest on the credibility of policymakers in bringing the rate back down at some point and firms believing that. But in theory, that appeal is there. In addition, by definition, such a reform would only apply to profitable companies. So that kind of allays concerns of squeezing out recovering businesses. Governments might even consider targeting this at sectors that have done particularly well, that have had windfall profits, for instance, from particular commodities. In the longer term, our focus is on policies which have substantial revenue potential and longer term payoffs from improving the tax system in other ways. And we think one example here, very broadly, is tax expenditures, which of course include a wide range of different policies, but we think in general, there's a good case for these to be better reported on, reviewed, and ultimately reduced. Firstly, because they're very costly in terms of revenue foregone. A recent estimate of around 3% of GDP in Africa from the Global Tax Expenditures Database, which the authors stress is a lower bound. That database also stresses that these are rarely reported on, so lack transparency and lack the evidence base to assess their effectiveness. They also create horizontal inequities by treating different taxpayers differently and are likely to be regressive in many cases too. In the report, we dedicate a special discussion to VAT exemptions and reduced rates, which are one type of tax expenditure and a particularly large source of revenue loss and poorly targeted for achieving redistribution. So we think in a lot of cases, they warrant review. So while it's hard to make very broad statements about tax expenditures, given the variety of policies which are included there, overall, we think there's lots of scope for streamlining these for a fairer, more efficient tax system, while also increasing revenue. So I'll sum up very quickly now to say that overall, sub-Saharan African countries face a difficult economic and fiscal outlook, and many will be looking for ways to improve public finances in the coming years or might already be doing so. If pursuing fiscal consolidation measures, governments should ideally wait for economic recovery to take root and wait for the right policies to be implementable. If they do need to implement short-term measures to raise revenue, they should be particularly mindful of the demand side impacts, however. Thanks very much. And I'll now pass on to Vedant.
Hi. So thank you, Ross, for that great presentation. I'll be speaking about motoring taxes in sub-Saharan Africa. So obviously motoring brings a lot of private benefits and, well, it just makes it easier to get around, but it also brings a lot of external costs, congestion, pollution, road fatalities. So governments have an opportunity to use taxes to correct those external costs by disincentivizing driving in some cases. And at the same time, they can get much needed revenues from motoring taxes. So I'll first discuss what the economic and environmental context looks like in sub-Saharan Africa with referring to motoring. I'll then discuss what existing taxes look like in sub-Saharan Africa. And I'll then conclude by discussing what policy options governments have in order to better design their motoring taxes. So the key stat in terms of the economic context is that despite high economic growth, vehicle ownership is still very, very low in sub-Saharan Africa. There are 26 vehicles per 1,000 people in sub-Saharan Africa compared to 182 per 1,000 in the world. And as you can see, some countries at this low end have a much lower level of vehicle ownership still. However, vehicles are heavily concentrated in cities. In some countries we looked at, 60 to 80% of all vehicles in the country were concentrated in the larger city. And vehicles are of poor quality. The United Nations did a study recently of vehicles exported to sub-Saharan Africa, and most vehicles in sub-Saharan Africa are imported from Europe or North America or Japan. And vehicles exported to sub-Saharan Africa, the average age was 16 to 20 years, and many wouldn't pass roadworthiness tests in their own countries. So these last two facts probably explains some of the things on the next slide. So congestion is a big and growing problem in sub-Saharan Africa. In Kampala, Nairobi, and Lagos, congestion costs 4 to 15% of city GDP. And this is due to things like workers not being able to get to work on time, businesses not being able to transport goods. In addition, sub-Saharan Africa experiences more deaths due to air pollution and road fatalities than the world average, again, despite having a lower number of vehicles. Greenhouse gas emissions, they get a lot of attention. Greenhouse gas emissions from transport are quite low, probably due to the low number of vehicles. However, governments are keen to manage emissions in line with their Paris Agreement obligations. And greenhouse gas emissions, it should be said, are growing quite quickly. So I'll talk about how motoring taxes are a good instrument to deal with the external costs of motoring. However, they aren't it should be bear in mind that they aren't the only instrument. They should be considered part of a policy toolkit alongside things like regulation, better licensing, better road safety standards, etc. So in terms of existing taxes on motoring in sub-Saharan Africa, the key ones I'm going to look at are taxes on fuel, taxes on vehicle ownership, and taxes on vehicle purchase. So taxes on fuel vary a lot between countries, but subsidies and undercollection are a problem. So this graph shows what official taxes on 1 liter of imported gasoline with a pre-tax price of 50 cents, official tax rates. So the mean here in these sub-Saharan African countries is about 21 cents for 1 liter. For comparison, the value for middle and high income countries is about 80 cents. And within sub-Saharan Africa, there's a lot of variation. At the high end, countries like Kenya and Djibouti have an official tax rate of 50 cents per liter of gasoline. Eswatini, Botswana, Angola, the taxes are very low, close to zero actually. However, the key thing here is the word official. In reality, effective tax rates on fuel can differ quite a lot from official tax rates for 2 key reasons. One is under collection, so rates not being applied at VAT rates and excise tax rates and tariffs not being applied at the full legal level, and stabilization. So many governments stabilize the price of fuel in order to ensure consumers. However, stabilization often means subsidies in most years. So for example, in Ethiopia in the last year, under collection and stabilization reduced what should be a tax of 31 cents per liter to a net subsidy of 9 cents per liter. And most countries in Africa have some sort of government fuel stabilization program. So there's probably a fair bit of hidden subsidies. So on vehicle ownership taxes, so taxes on vehicle ownership, they're generally quite low and they don't exist in many countries. So this graph presents annual taxes on a 5-year-old vehicle with a pre-tax price, sorry, with an engine size of 1600 cc. And only for countries where we could find evidence of a vehicle ownership tax existing. So we couldn't find evidence of vehicle ownership tax existing in most sub-Saharan African countries. In the countries we could find evidence of them existing, taxes were about $49 on average. For comparison, the same value in middle and high income countries is about $200. And in a lot of countries, so Senegal, Kenya, Ethiopia, they're very low, pretty much close to zero. Now, in stark contrast, taxes on vehicle purchase are actually really, really high. So this is taxes on a 5-year-old imported car with a pre-tax price of $5,000, engine size 1600 cc. So taxes on vehicle purchase, they're actually the only category in which taxes in sub-Saharan Africa are higher than middle and high income countries. So tax in sub-Saharan Africa, the average is about $3,000 for this type of vehicle. In middle and high income countries, the average is more like $2,000. again, there's huge variation. Ethiopia obviously is on is off the spectrum. I think taxes there are about $30,000. But even looking at low, supposedly low tax countries, Angola, Liberia, taxes are still fairly high, about $1,200 for this type of vehicle. So there aren't any particularly low tax countries for tax on vehicle purchase. So those are tax rates, and the main finding here is, the taxes on vehicle purchase are, generally quite high. Taxes on fuel vehicle ownership are a little bit lower than middle and high income countries. Looking to tax revenues, so these are motoring tax revenues for our 4 TaxDev partner countries where we could get the data for. As you can see, motoring taxes, tax on vehicle import and fuel, raised between 0.8% and 2.1% of GDP, which is actually a similar level to EU countries. And it's quite surprising given that in these countries, I think the average ratio of tax to GDP is between 15 and 20%. So motoring taxes, at least in these 4 countries, are actually fairly significant already. So to conclude, do motoring taxes represent a double dividend, both revenues and environmental protection? Well, at least in the 4 countries that we have, where we could get revenue data, motoring taxes already raised quite a lot of revenue. It's difficult to, obviously we don't have data for every country, but it's difficult to really argue that motoring taxes are an untapped source of revenue across the continent. I mean, the reason that motoring taxes are, relatively high in terms of revenue, it's probably because they're easy to administer, especially fuel and vehicles, which are generally imported, and because they're very progressive. So I think in the countries we looked at, motoring, fuel and vehicles were overwhelmingly consumed by the top decile. However, Sub-Saharan Africa still suffers from a lot of social and environmental problems from motoring: congestion, air pollution, road accidents, greenhouse gas emissions. In some cases, these are worse than the world average, despite the region having a lower level of motorization. And I should note that they're heavily concentrated in urban areas. Now, that's quite important for policy implications. Now, these problems, congestion, pollution, etc., they're linked with vehicle use. Obviously, a parked car doesn't do much harm. They're linked with the time and place of driving, peak hours versus off-peak hours, rural versus urban, and they're linked with the type of vehicle driven. A gas guzzler is worse than an electric car. So countries do have an opportunity to reform motoring taxes to make them better targeted to deal with the problems with motoring. Currently, taxes are quite skewed towards vehicle purchase taxes. Now, vehicle purchase taxes, they're a poor way to deal with the problems with motoring because, well, once you've purchased the vehicle, you have no incentive to not drive it as much as you like. You can drive it during congested hours. You can, you can drive it during peak times in urban areas. And the worst thing is because of, in some countries that have very high vehicle purchase taxes, drivers of old vehicles, potentially old, broken down, polluting vehicles, might be hesitant to trade in for newer, cleaner vehicles because the taxes only apply at the point of purchase. So I'm going to just discuss some potentially better policy options. One is to increase taxes on the price on fuel. So fuel taxes directly target vehicle use, because if you drive more, you use more fuel, so therefore fuel is fairly well correlated with how much you drive, and how much you drive is correlated with how much externalities, external costs you produce. Also, because more polluting cars tend to use more fuel, you also target more polluting cars more. On the other hand, the main disadvantage is that fuel taxes are politically unpopular. In a lot of sub-Saharan African countries, you see a lot of protests in response to fuel price increases, which is a bit strange given that we know that they're actually very progressive. Another option that countries can look into is increasing, or in some cases, introducing vehicle ownership taxes. So vehicle ownership taxes, although they don't target vehicle use directly, what they can do is it can be varied by the type of vehicle. So more polluting vehicles receive a higher annual ownership tax. And what's especially good is that they can be higher for drivers in urban regions, which taxes urban regions where the problems are whilst insulating rural economic development. In addition, certain vehicles such as minibuses, which are important for public transport for the middle classes and the poor, can be exempted. The main disadvantage here, and potentially one of the reasons why they're not as widespread, is that vehicle ownership taxes are harder to administer. You need a register of all the vehicles in the country. You need, evasion potentially could be a problem. Another tool to deal with the, specifically urban problems that a lot of sub-Saharan African countries face are higher parking charges in urban areas. Again, this directly targets the congestion and pollution in urban areas by making it more expensive to drive in urban areas. Of course, there are setup costs and ongoing labor costs with doing so. Now, in terms of vehicle purchase taxes, I can understand a lot of countries would be hesitant to get rid of vehicle purchase taxes completely because they are an important source of revenue that's fairly easy to administer. However, there are definitely options for reform. Some countries, especially high tax countries, Zambia, Ethiopia, potentially have scope to reduce vehicle purchase taxes. Other countries may wish to at least use vehicle taxes as a better instrument to directly target the type of vehicles that come into the country. So very few countries in Africa now, I think South Africa is the only one, very few countries actually increase their vehicle taxes based on carbon emissions of the vehicle or emission standards that are based on small particulate emissions. So to conclude, sub-Saharan African countries have a lot to think about in terms of how they reform motoring taxes to make it better targeted at the economic environment, the social and environmental costs of motoring. The question of whether they can increase revenue at the same time is a bit unclear because they're already getting quite a lot of revenue from motoring taxes. So I hope you learned something new about motoring sub-Saharan Africa. I'll now hand over to my colleague Ian, who will talk about global corporate taxes.
Thank you very much, Vedant, and good afternoon, everybody. So my name's Ian Steele. I'm a research associate with the ODI. And as Vedant says, I'm going to talk about what the global tax deal could mean for lower income countries. And thanks again to Vedant for his contributions to this presentation. So many of you will have heard that last week, 130 countries in what's known as the G20 OECD Inclusive Framework have signed up to a set of global tax reforms. And those reforms are really in two parts that are called pillars in OECD speak. And there is Pillar 1, and that gives new taxing rights for consumer countries on the largest multinational enterprises. And the second part of this, called Pillar 2, is the global minimum tax of at least 15%. And in this session, I'm going to try to answer three questions. Firstly, why was a global deal needed? Second, will lower income countries gain from the new Pillar 1 taxing rights? And third, how can lower income countries benefit from the new global minimum tax? However, not all the details have been agreed yet. Negotiations will continue this year, and then whatever is finally agreed to will need legislating. So there's still quite a long way to go. And secondly, these reforms are very complex. So we're only going to be covering some elements of the reforms and only at a high level given the time we have available. So why was a global deal needed? Now, the current system of international tax is over 100 years old. It dates back to the League of Nations and really was designed for what's known as the bricks and mortar economy. Now, that system has come under increasing strain in recent years, particularly due to the digitalization of the economy. And to understand where those strains are impacting, we can look at a typical multinational enterprise and how it's structured and where its activities are. So here we have a multinational that has its headquarters in its home country on the left-hand side, and that's usually a high-income, high-tax country. And it will make sales into what we'll call consumer countries on the right-hand side. And again, those are often high-tax countries. However, over time, an increasing amount of the functions of a multinational, which are often quite mobile, have ended up in these intermediate countries, which are often low tax countries or often preferential regimes. So these are things like intellectual property, finance functions, sales and marketing, and manufacturing. And that means that over time, an increasing amount of profits have ended up being in these low tax countries and not collected in the home country or the consumer countries. So there are two consequences of this. The first is what's called the race to the bottom, which I'm sure many of you will be familiar with. And basically over the last 30 years or so, countries around the world have been reducing their statutory rates of corporate income tax over time to try to attract and retain the activities of multinationals in their countries. And the second consequence is what's known as scale without mass. And what the scale without mass means is basically, again, with the digitalization of the economy, you now have a set of internet companies, be they search engines or social media or streaming companies, that are able to sell at scale into consumer countries, but without having a place of business or any employees there, so without having any mass. And the current system of international tax assigns taxing rights based on having a physical presence. So what this means is that the consumer countries are missing out on taxing rights over the sales that are made in their countries because the multinational has no physical presence to tax. And that's the scale without mass problem. So what the two pillars of reforms do is they try to address each of these separately. So pillar one is going to reallocate some profits of the largest multinationals into consumer countries, regardless of having a physical presence or not. And what pillar two does is it addresses the race to the bottom by imposing a global minimum tax of at least 15%. So we're going to look at both of these two pillars and see what they might mean for lower income countries. So firstly, will low income countries gain from pillar one? Now, the first thing to say about pillar one is that it only applies to some of the very largest multinationals. So firstly, a multinational would have to have global revenues of more than 20 billion euros to be included in this. Now that could be reduced to 10 billion euros after 7 years on review. And some multinationals are not included because their activities are out of scope. So the activities that are in scope are things like automated digital services, so search engines, social media, and what have you, and consumer-facing businesses, so multinationals that are selling consumer goods and services into economies to consumers. Out of scope are two key sectors. One is extractive industries, so oil and gas and mining, and two are regulated financial services. And in these sectors, the challenges from the digital economy are less acute. But importantly, for lower income countries, excluding extractive industries should be a real benefit to them. Now, it's a fundamental principle of extractives that host countries that have oil and gas or have minerals should be able to collect profits on those because the state owns those resources. Now, had they been included in this reform, there would have been a reallocation of those taxing rights into the countries that import petroleum products or minerals. And because a lot of lower income countries depend on natural resources to generate revenues, they would have lost out had they been included. So it's actually a good thing that extractives are excluded for lower income countries. And the second thing to realize is that we're talking only about 100 or so of the largest multinational enterprises here. And the global gains from this are going to be relatively modest because we're only going to be reallocating between 20 and 30% of what's called residual profits. So those are profits above 10%. Now, the OECD estimate that that will lead to a reallocation of at least 100 billion of profits per year. Now, because profits are usually taxed at a rate of somewhere around 24% on average, we're only talking about 24 billion or so of corporate income tax revenues, and they're going to be reallocated between 130 countries. So the overall impact is quite modest. The OECD estimates that it will lead to an increase of less than 1% of global corporate income tax revenues, and that's due to the reallocation of profits from low tax investment hubs into higher tax countries. But the good news for lower income countries is that they will get a share of these new taxing rights. Now, ordinarily to get a share, the multinational would need to make a minimum of 1 million euros in your country for you to qualify. Now, that threshold of 1 million euros would have excluded some of the smallest, lowest income countries in the world. And the OECD estimated that between 13 and 60% of the benefits from this could have been lost with a 1 million threshold. And we're talking about low-income countries here like Djibouti, Liberia, or Sierra Leone. So the good news for low-income countries is that there is a special domestic revenue threshold for small countries that's set at a lower 250,000 euros, and that should ensure that low-income countries get to benefit in these reforms. And actually, the OECD think that lower-income countries could gain most in relative terms, so relative to their current corporate income tax revenues, they could gain an additional 1%. However, I would say that we should take a little bit of caution into reading these numbers too literally. Firstly, the package that was modeled by the OECD earlier in the year doesn't reflect the final agreement, and particularly doesn't reflect the increase of the global revenue threshold from the proposed 750 million up to 20 billion euros. And secondly, understandably, there are some uncertainties in these estimates because data is patchy, particularly for low-income countries, and the OECD have had to make a number of assumptions about how countries and firms will respond to the reforms. So I wouldn't take these too literally, but the news appears to be that low-income countries should benefit from these Pillar 1 reforms. Turning to the global minimum tax, the important difference here is that all multinational enterprises with global revenues above 750 million euros will be included in the global minimum tax. And now we're looking at about 8,000 multinational enterprises. Now, to understand how this works, we'll return to our original diagram where you have a home country that has the headquarters of multinational, and that has a tax rate above the global minimum. You have consumer countries, again, where it makes sales with an effective tax rate above the global minimum. But you have these functions in these intermediate countries where the tax rate is below the global minimum of at least 15%. And what the minimum tax will do is it will give first taxing rights to the home country. So that means that the home country will be able to top up taxes paid by the parent company for those under-taxed profits in those intermediate countries. Now, only if the home country doesn't join this proposal or doesn't apply the top-up tax could other countries benefit. Now, the rules around that are still to be agreed. It's only intended as a backup. I think it's probably safe to say that most of the benefits here will go to the home country. The second issue with the global minimum tax is what's called substance-based carve-outs. And what they do is they enable multinationals to exclude from their income used to calculate the effective tax rate some measure of income based on having assets or employees in the country. And that can mean that you still end up with effective tax rates below 15% in some countries. And that means that tax competition is likely to continue, especially for things like manufacturing. So the OECD think that high-income countries will gain the most from these reforms, and the pure mechanical response, so this is without any changes to behaviour, suggests that it could be between 2.5% and 4% of corporate income tax revenues in those high-income countries, and that's because they get the first taxing rights. If you include the behavioural response, so if firms respond by reducing their profit shifting, then lower-income countries could gain a lot more. But again, high-income countries are going to be the biggest winners from this reform. So what can low-income countries do about this? Well, first, they could push for a higher minimum tax rate. Statutory CIT rates tend to be quite high on average in low-income countries, and certainly higher than the 15%, so the incentive to shift profits will remain. Now, a higher minimum rate would reduce this incentive, but will other countries agree to it? The second thing lower income countries can do is avoid having effective tax rates below the global minimum in their own jurisdiction. Now, the reason you should avoid this is because if you're not taxing the company at 15%, the high income country where that multinational is headquartered will be taxing those profits. And that means that actually this will be a transfer of taxing rights away from low income countries into high income countries, which is not a particularly desirable outcome for international development efforts. However, doing this could be difficult in practice for lower income countries. They may need to renegotiate tax incentives, or they might need to create their own domestic minimum tax of 15%. Now, this isn't easy again, because there is a pretty high risk of international arbitration in the cases where multinationals have contracts with states that stabilize their fiscal terms and stabilize their incentives. And this is an area I think that increasingly the inclusive framework will need to look at. The third thing that lower income countries could do is apply what's called the subject to tax rule, which is a new element of the Pillar 2 reforms, and that can be used to address profit shifting. So the way this works, and we'll give an example here from mining, is that typically in mining, you'll have a company that is located in a lower income country where the mine site is, but to finance the development of the mine, they'll use a financing hub in a low tax country. That financing hub will borrow from an unrelated bank in the market and on-lend that financing to the mining company so they can construct the mine. Now, the financing hub might pay a 4% interest rate on the basis of it being a large global multinational with a healthy balance sheet, but when it lends to the mining company in the lower income country, it might charge a higher, say 12% interest rate. So the mining company can deduct 12% interest from its taxable income in the lower income country and effectively shift profits into the financing hub. And what the subject to tax rule says is that the tax authority in the lower income country can apply a top-up tax on that outbound payment of interest if it's made to an affiliate company in a low tax country. Now, the details are still to be resolved, but this could lead to a top-up tax of up to 9% of the payment amount. Now, because it's a top-up to withholding taxes, it requires amendments to bilateral tax treaties. But the good news for lower income countries here is all 130 members have signed up to an agreement that says if a developing country requests an amendment to their bilateral tax treaty, they will be granted it. So what do we make of all of this? Well, firstly, the Pillar 1 overall benefits are likely to be small, but at least lower income countries will get a share of them. Secondly, the benefits from Pillar 2, the global minimum tax, will mostly go to higher income countries, but there are things lower income countries can do, such as pushing for a higher minimum rate, avoiding taxing companies in their own country below the minimum rate, and applying this new subject to tax rule. And finally, I think it's fair to say that these reforms are unlikely to end all of the problems of global tax. Tax competition is likely to continue, and lower income countries will need to continue to build capacity in revenue authorities to address international tax avoidance, for example, through transfer pricing audits. So these reforms won't solve all the problems, but it looks like there is some good news for lower income countries, but some challenges for them to be able to benefit. So thank you very much for listening. I'm now going to hand over to Anne, who's going to talk about property taxes.
Thank you, Ian, and thanks everybody for joining. So I'll talk about whether property taxes can be a tool for raising revenue in lower income countries. Property taxes are a potentially attractive tax instrument. For one, because they're very difficult to evade or avoid, at least in the short run. That's because the tax base is an easily observable and immovable asset. You can't really hide your house. You could potentially move to a different area with a lower tax rate, but that might not happen in the short run. It might happen in the medium or long run, and it's quite a big response to this tax. The second attractive feature is that the property tax is essentially a form of a wealth tax and can therefore be desirable from a distributional perspective, which can be important, especially in contexts where income tax capacity is weak. And finally, property taxes are often the most important or one of the most important sources of local tax revenue and can therefore create strong synergies between tax compliance and local public goods provision. Now, despite these attractive features, property tax revenue in lower income countries is actually very low. So this figure here shows you the ratio of tax revenue to GDP in high versus low income countries for different tax instruments. So for the corporate income tax, we see that high and low income countries raise about the same share of GDP in this tax. For the value added tax, high income countries raise already a bit more. For the personal income tax, high income countries raise about 3 times as much revenue. But the property tax is really an outlier where high income countries raise 8 times as much revenue as low income countries. So there's definitely scope to increase revenue. The question is whether this potential to increase revenue can actually be realized, and if yes, what policy instruments we should look to use to increase property tax revenues. And the 2 policy instruments I want to think about here are tax rate increases and tax enforcement. Now, tax rate increases may raise more revenue from those taxpayers who are already paying the tax, but they can also inflict a welfare cost on households who may already be suffering from liquidity or credit constraints, which we know are prevalent in lower income countries. And here, the property tax is really distinct from taxes on income or consumption, which are levied on a flow. The property tax instead is levied on a stock. And so you could imagine that households with a big house, but a small flow of income could struggle to pay their property tax. Now, when it comes to enforcement, that's another tool that may raise revenue, but also at a welfare cost, a different type of cost here. Here, you might inflict a cost on households that are, subject to enforcement, but actually truly unable to pay the tax. They could suffer a moral cost, which you could think of as feelings of guilt or shame, for instance. I want to now think about and present you some evidence on the effect of tax rate changes and enforcement and building on a paper on property taxation in Mexico City that I did with several co-authors. And the paper is available on our website and may also be posted in the chat. So in Mexico City, the property tax schedule looks as follows. The properties are essentially allocated into property value bands depending on their cadastral value. And the lowest value properties have just a lump sum tax. And after that, the tax rate is increasing in the property value. The tax rates are also updated every year, pretty much in line with inflation. But over time, the government removed certain credits and exemptions. And that led to large increases in the tax rate in specific value bands. And the way these credits and exemptions were removed happened one value band at a time. So in the year 2010, properties in band I got a pretty large increase in their tax rate, much larger than the tax rate increase in adjacent value bands. And so that gives us the opportunity to compare properties in this band I to properties in band H just below, so properties of a very similar value, but who did not get this large increase in the tax rate. And so we find that when we plot the tax payment by property value, and here we're zooming in on properties around this threshold here between property value bands H and I. So all the properties on the right of this line are treated with this large tax rate increase. Properties on the left are not treated. And we see that the increase in the tax rate leads to a large increase in tax payment. Now, compliance also does fall. So there are some taxpayers that get this increase in the tax rate and just completely stop paying. But because what those of the taxpayers who continue to pay more that's a larger amount than the compliance drop, we overall have an increase in overall tax payments. However, we also need to think about the potential welfare cost. And here capturing liquidity and credit constraints precisely is quite tricky. So we have evidence from a proxy of liquidity constraints, which is the likelihood of paying the tax in installments. So taxpayers can either pay their annual tax liability all at once in the beginning of the year, in which case they also get a discount. So you definitely want to pay all at once if you can. But if you can't, then you can pay in installments every other month. And this figure here shows you that properties in the treated value band, so the ones that get the large increase in the tax rate, become more likely to pay their tax in installments after the reform kicks in. So there's clearly a welfare cost. And in the paper, we feed these estimates into a model to think about how the welfare cost compares to the revenue gains. Now, looking at enforcement, we use evidence from a field experiment where the tax administration sent letters to delinquent taxpayers and asked them to please pay their tax. And we find that taxpayers definitely react to these letters here. And so taxpayers in the treatment group, which is the red line, pay much more tax than taxpayers in the control group who did not receive a letter. And in the end, they remit about 50 pesos more tax. Now, to really draw policy implications from this, we have to compare the size of these revenue gains from enforcement and from the tax rate changes. And while we find that both tools do raise revenue, the tax rate increases actually raise orders of magnitude more revenue. In fact, the tax hikes that we study over a 3-year period in Mexico City increased revenue by about 36%. So that's a very large aggregate revenue gain. Now, both policies also generate welfare costs, which we demonstrate. But when you try to quantify these welfare costs, you can actually see that the tax rate changes, despite the fact that they may generate some liquidity costs for some taxpayers, are still much more desirable from a welfare perspective than tax enforcement as a policy tool. Thank you very much, and I look forward to the discussion. And I'll hand back to Hazel.
Thank you very much, everyone. There's a lot of information there, and we've been getting some good comments and questions in the chat. We're running a little over time, so we have about 5 minutes to respond to some of those, and then we'll move on to the panel discussion. So if I look at the comments that are coming up, there's a few comments from Edward Abrokwa, who makes the point that a lot of countries have very limited fiscal space. He's responding to Ross's presentation, which may need some painful fiscal adjustments to be able to preserve the economic system. And he also mentions that, unfortunately, because of stability clauses in some sectors, especially extractives, that means that countries are also limited in what they can do, especially in terms of increasing corporate tax rates, for example. He also makes a point responding to Vedant's presentation about motoring taxes to do with how unpopular fuel taxes are and some of the reasons for that, particularly the impact that it might have on the general price level by increasingly pushing up the cost of production on a range of items in the economy. So there are a couple of questions for Ross. I can see Tom O'Kane asks about the wealth tax, and do you have any thoughts on the admin costs versus the revenue potential of the tax? And Bradley Kent wants to know what Ross's thoughts are on increasing fiscal harmonisation in sub-Saharan Africa as a means of improving regional development. Ross, I don't know if you would like to respond to either of those questions or Edward's comment.
Sure. So on Edward's comment, yeah, certainly one of the considerations that we laid out is the possibility that liquidity constraints might necessitate fiscal consolidation earlier than would be ideal. And one of the arguments for delaying fiscal consolidation is this idea of fiscal multipliers being larger during a downturn, which could deepen a crisis if tax increases or expenditure cuts are enacted in the current moment. I suppose one kind of possibly comforting bit of evidence from the slim literature on fiscal multipliers in Africa is that the existing evidence suggests that particularly in high debt countries, fiscal multipliers are quite low or sometimes even negative in low income countries. So perhaps that argument that we put forward about fiscal multipliers and therefore delaying fiscal consolidation, if possible, is not quite as pertinent in some high debt countries as is generally laid out in the literature. Coming on to the wealth tax point, yeah, so the admin side of things is crucial. The wealth tax, the one-off wealth tax in particular, is a policy which has some really desirable features in theory, and we've seen lots more discussion of such a tax in Europe and in the US, and even in Latin America. There's a few countries that are implementing one-off wealth taxes at the moment in response to the COVID crisis. There's no precedent for these types of taxes in sub-Saharan Africa, and that's probably precisely because of the very difficult administration element of the tax. In fact, we don't really even know what wealth distributions look like in sub-Saharan African countries, regardless of trying to compile comprehensive individual level net wealth statistics. So we do discuss this in our report, and our kind of tentative conclusion is that one-off wealth taxes are probably not actually feasible in most sub-Saharan African countries, even if they do have some quite desirable features, and even if high net worth units maybe are a first step towards compiling that kind of information. But yeah, admin is definitely key. And finally, on the fiscal harmonization point, yeah, to the extent that differences in tax rates in sub-Saharan Africa across countries are reflecting tax competition that just shifts activity across countries in the region, then there could be some value to some harmonization of certain taxes that are particularly influential in dictating where activity occurs in the region. I wouldn't know exactly what the sort of magnitude of that effect is, but I suppose exactly the points that Ian's been talking about could partially address some of that, and also the tax expenditures that we discuss in our report are kind of a hidden, often hidden form of tax competition. And so reducing those could go some way to reducing that interregional competition and increasing revenues.
Thank you very much, Ross. I think in the interest of time, I'd like to move on to the panel discussion. Perhaps the presenters who can see questions posed to them can provide a brief answer in the chat, if possible, and obviously we'll try to get back to as many people as we can, and hopefully find a way to continue the conversation after the meeting. But I'd like to move on now. We have 3 experts. So we have 3 country experts with us today. Each of them were going to speak briefly about the challenges and opportunities in their countries, and any reactions they have to these presentations. And then we'll have a bit more time at the end for some more questions. So again, please continue to put your questions in the chat as we go along. So I'd like to introduce our panel. Firstly, we have Walela Yesagat. Walela, I don't know if you can turn on your camera so we can see you. Walela is Assistant Professor of Taxation at the College of Business and Economics at Addis Ababa University, Ethiopia. Walela has completed several studies on the Ethiopian fiscal system and published in tax journals, and has been a tax advisor to the Ethiopian government. And secondly, we have Dennis Mukama, who is Acting Deputy Commissioner of Research and Planning at the Rwanda Revenue Authority. He has worked at the RRA for 14 years and is responsible for overseeing RRA's research activities, tax policy analysis and statistics, and he's been the lead representative for the RRA in developing Rwanda's medium-term revenue strategy. And then finally, we have Daniel Nua, who is the head of tax policy unit in the Ministry of Finance in Ghana. And Dan is an experienced public servant who has specialised in tax administration and tax policy. And prior to taking up his position at the Ministry of Finance, he was also the monitoring and evaluation manager at the Ghana Revenue Authority. So welcome, Walela, Dennis and Daniel. And I'd like to start with Walela, please. If you can turn on your camera and you go, thank you.
Thank you, Hazel. Good afternoon. First, I would like to have a couple of points on the presentations, on some of the presentations, then I'll make my points as issues in the Ethiopian tax system. Thank you for the presentations. I start from the paper on property taxation. As I noted from the perspective of African countries, most African countries, there are a lot of studies that show the underutilization of property taxes. As she noted, the rates are very low. There is weak performance, revenue performance is very low. And in many of the African countries, these property taxes are based on outdated legislation. So the policy implications she highlighted, I think will be, applicable to many of the African countries. I mean, it's good insight for African countries' policymakers to look into as their COVID recovery, tax measures. That's one point. The other thing is on green tax paper. I noted from the presentation that the taxes on purchases of motor vehicles from the side of Ethiopia, reported to be very high. But I think in making such a comparison, it's important to factor in the motor vehicle regulations of those countries. To my knowledge, there are a number of countries that completely ban the importation of, used vehicles. On the other hand, there are countries that do not have any restriction at all. For example, in Ethiopia, there is no restriction in the importation of used vehicles. Instead of banning those kinds of vehicles, what we have is, a really high excise tax rate with the intention of, prohibiting importers from bringing in those old vehicles. So in such kind of comparative analysis, I think it will be really helpful information if we factor in what we have in terms of regulation so that we can create label kind of comparative analysis among countries with that respect. Having noted these 2 points, I will try to raise the key challenge in the Ethiopian tax system. Like many of the African countries in Ethiopia, the main challenge is the excessive use of tax concessions. There are a lot of tax exemptions here and there, which erode the tax base and contribute partly to the poor revenue performance in the country. Currently, the tax to GDP ratio in Ethiopia is about 10%. That's partly because of the continuous erosion in the base due to the numerous exemptions out there. In order to see the magnitude of tax expenditure, recently there was an attempt by the government to estimate the tax expenditure, and it's about 5% of GDP. It's almost half of the total tax revenue collection in the country. In addition to that, in addition to granting exemptions, there is no, attempt to look back and see how effective those concessions are. There is exemption from time to time, but the effectiveness of those tax exemptions in terms of achieving the different government objectives is not really known. So from Ethiopia's perspective, this is a huge issue, really constraining the domestic resource mobilization effort of the government. The other key problem I see is capacity limitation. Capacity limitation in terms of tax policy making, in terms of tax administration, and even from the side of taxpayers. For a healthy tax system, capacity is a key. I mean, if they don't have the right expertise in tax policy analysis, in tax enforcement, and so forth, I think everything is likely to remain on paper. So the other issue in the tax system in Ethiopia is capacity limitation. Not only that, the use of IT solutions in tax administration is really limited. Data for proper analysis of different policy options, that's also another problem we have in Ethiopia. Tax compliance is really weak. There are evidences on the level of compliance in Ethiopia. For example, very recently, the IMF estimated VAT compliance gap in Ethiopia to be about 4.1% of GDP. This is in a country where the total tax collection stands at 10%. So tax compliance taking different forms, compliance problem, taking different forms is really a big problem out there. The other thing that I would like to mention is lack of a well-structured and coordinated approach by the Ministry of Finance and Ministry of Revenue in dealing with the tax system. When I say this, it doesn't mean necessarily that the two institutions do not interact at all, but the level of interaction, the level of coordination of efforts between the two, I don't think is up to what's expected from them. Even they don't have, a unified revenue strategy that has the buy-in from both ministries and also from other stakeholder institutions. I think these are the points I thought would be worth mentioning for the purpose of this discussion. Thank you very much.
Thank you very much, Walela. That's really interesting. Thank you. So I think before we have questions, we'll also go to Dennis and Dan. So next we have Dennis from the Rwanda Revenue Authority to talk about the challenges and opportunities in Rwanda.
Yes, hi Hazel, and thanks for the opportunity. Hi everyone, and good presentations made by the presenters. I think they tackle most of the challenges we are facing, especially under this pandemic. So I will try to be as brief as possible. I don't think I'll go through each and every presentation as made. Maybe I will only focus on one or two. The presentation on fiscal consolidation, I think it really comes at the right moment. It comes at the moment when we, it really rallies well with what we are facing as developing countries, and more so in Rwanda. So most of the proposals they are putting together are proposals that we have actually been looking at as we are currently developing what we are calling the MTRS, or the medium-term revenue strategy. Because this is a strategy that we see that should align our revenue needs with our development needs with our sources of revenue. So most of these have been looked at. Not all of them have been considered. I will probably allude to that in a short while, but most of them have been categorically looked at and try to be weighed within the applicability in the Rwandan context. So the MTRS is more like I said, it's the way it's designed, because it comes at a moment when we are faced with challenges of revenue and also trying to beat the pandemic. So ours is really based on four main principles of supporting economic recovery, trying to simplify the tax system so that it's easy for many taxpayers to comply, and then also try to improve efficiency in widening the tax base, but at the same time also considering reducing rates as well as equity. So most of these now, how does this MTRS come in? It's coming in such a way that we are trying to make sure that in the first few years of the MTRS, we focus more on economic recovery, whereas the other aspects of widening the tax base will come in towards the end of the MTRS. So most of these policies that have been raised by this particular presentation are things that have also been considered, because we look at things like policies like VAT rebates to increase compliance, reviewing excise rates to make sure that we have the most appropriate excise rates. We have ad valorem vis-a-vis specific. There are policies aimed at building to recover, where there's some, exemptions, incentives given to some sectors. However, later on, again, you see that there's an introduction of the MAT, or the minimum alternative tax, a reduction in CIT rates, but also gradually doing away with the incentives. So I think a number of these resonate well with what Rwanda is looking at and achieving. When you look at motoring tax, I think also this is a very interesting paper as well, and we've also looked at a number of aspects. There are, however, certain things that I think also one of the comments in the in the questions was raising, that we need to look at these. I think some of these presentations need to give the full context when you're looking at the taxation of motor vehicles, whether you're looking at the fuel tax or you're looking at the purchase of the vehicle. I totally agree with many of the areas raised, that the purchase cost is a bit high. And in Rwanda, it can even get to as much as almost 70% of the price of the vehicle at importation. But then when you look at some of the proposals being suggested in terms of increasing the tax rate, some of these tax rates, I think there's really need to look at the particular context of each country. I know in Rwanda there are so many. It's already the motor vehicle tax is already taxed highly. When you look at the number of levies, I was doing a quick calculation, and there are almost 5 levies that are coming up. I mean, that are already applied to fuel, to fuel. So adding playing around with, you don't have that space to play around with a lot of, additional taxes. Instead, actually, to give you a bit of an example, recently when we were having, when the prices of the international markets were going up and pushing up the prices domestically, the government had to review some of the levies downwards. So that gives you a bit of a picture of the fiscal space under which you can play with some of these policies. Again, some of these things, I think some of these papers need to look at these proposals or the suggestions, looking at them in totality, because you may want to deter importation of certain vehicles or congestion. However, you need to know what is the alternatives. What are you giving as alternatives to the taxpayers? I mean, to the public. Most of the challenges we are facing in our developing countries is the public transport is not efficient. So some of these people do buy vehicles not because it's a luxury, but because it's a necessity. So they have to be taken in totality when you're looking at all these suggestions. I know we in Rwanda, for instance, I think hardly within this month, there's a pilot of using also greener alternatives like bicycles and all that, but its effectiveness to replace vehicles will be tested in due time. But also you have to look at aspects like the terrain. So, there are a number of things that you have to look at when you're proposing only one aspect of, looking at a certain aspect, and then vis-a-vis the other alternatives that are at our disposal. So again, for the minimum, I mean, the global minimum tax, I think that was also, I think he did a good justice to the presentation. There's some good news out there. And I think Rwanda as well is also looking forward to the discussions with OECD. However, as developing countries, I think waiting for the OECD to finalize all these beautiful discussions and benefit from the outcomes, I think there's also a need to make sure that it's not only the discussions of the OECD that are being taken and brought to the developing countries. I think they also need to be put in line with an African perspective or low-income development or low-income countries perspective. That's why a lot of discussions have been going on with the ATAF, and Rwanda is also very actively involved with the ATAF to make sure that there's, much as we are monitoring what's happening, there's also a joint understanding of what are the aspects that are really pressing for the developing countries that also need to be considered. So I think I'll end for now. I guess I've exceeded my 5 minutes. But thank you so much.
Thank you very much, Dennis. Yeah, I didn't really want to interrupt you. There was lots of interesting points there, especially about thinking about tax in the wider context of other policy instruments and how effective they need to work together. So now I'd like to go to Dan Ewer from the Tax Policy Unit in Ghana.
Yep. I want to share my screen. Well, where is it? One second. There it is. I'm sharing my screen. I hope you can see it. Can you see my screen?
Yes.
You can see it. Okay. Good afternoon, everybody. And thank you to the presenters for their various presentations and their reactions. What I'll do is that I'll address some issues that they presented while I do this presentation, since they basically fall within it. Now, for Ghana, COVID-19 came as a very interesting surprise, or a hiccup, to put it that way, a very big hiccup. We had started a period of modernization. We were working on quite a number of things. Then basically 2020 came in and brought out a very big issue. I mean, overnight, we had a 13 billion cedi decrease in revenue, expected decrease in revenue for the 2020 budget, which was about 19, almost 20% of the revenue budget gone. On the expenditure side, we had about another 12 billion excess expenditure, which was about 14% above what we had budgeted, just overnight. So yeah, so basically we're looking at losing 13 plus 20, about a 25 billion CD gap. Now, in some measures we're taking with the year to attend to the problem. Fortunately, we're able to do a bit better than we planned. Ghana was a bit better off. Instead of having negative growth in terms of GDP, we had something which was slightly positive, very minimal, but at least wasn't negative. So government came out with a program which we call the Ghana COVID-19 Alleviation and Revitalization of Enterprises Support Program, the Ghana Cares Obatampa program, to bring the economy back on track. And out of that is the 100 billion was expected that the resources that will be used to support it, 30% will come from the public sector. Now that involved revenue collection, improving revenue, narrowing tax exemptions, tighter fiscal discipline. So we're looking not only on the revenue side, but also on the expenditure side, not necessarily decreasing expenditure, but being more efficient. So in terms of public investment program, being more efficient and prioritizing what we really needed to get. At the end of the period, we expected that tax to GDP would improve from around the 13% that we had at the end of 2020 to 20% within a 3 to 4 year window. So by 2024, basically, we expect that we would have a tax to GDP ratio of 20%. Quite steep, but as someone said, not impossible. So out of these, in terms of fiscal consolidation, and Ross broke it up into short and long term, one of the things we're looking at base broadening. So not the base broadening, not just bringing in additional tax, but widening and deepening even existing revenue sources. So there was the issue about VAT. For example, it's one of the things we are looking at in terms of how do we improve our VAT, because currently what we really get to VAT is less than 50% of what we expect to be getting. So it means that there seems to be something missing. The other thing we are looking at is to use a lot more technology. In Ghana, we have our tax system, we have the basic laws really that we need. In terms of policy, we really don't have too much of an issue with policy. The problem is that our policies are sort of sometimes ad hoc and short term. So we are working on a medium-term revenue policy, and with that would then shift to the strategy, sort out the policies in one document, have a clear cut, and then shift to the strategies we need to support those policies. So some of the things we are looking at in terms of that is so as part of automating, making sure we automate basically all the processes in tax administration, and makes it easier, improves efficiency. Then also as part of that automation and using technology, we would also be able then to monitor taxpayers. There's a lot of interaction when it comes to the, should I say, multinationals. There's a joke that we have that Ghana is a procurement economy, which means we bring in a lot of goods from outside. So there are supposed to be taxes on all these things, both on the services. We import a lot of services on which there should be VAT. So these are some of the things that we are looking at. Then narrowing of tax exemptions was talked about. The issue here is that tax expenditures exist everywhere. The issue is to stop the issue of abuse and have better management and make them more efficient. We've talked, we are looking at reviewing our revenue legislation. I always say that Ghana, we are fortunate when it comes to this digital taxation issue, because our VAT Act already provides for that. Our Income Tax Act has those provisions. It's just a matter of updating them and tweaking them a little bit more in order to do their things. So this and a little more administrative efficiency, enforcement, and intelligence and other things, and improving customs operation and collections, we expect that we'll be able to sort it. So we are looking more at compliance actually and implementation of the laws that we have to meet this. In terms of property taxes, there's a lot of automation going on and a lot of work being done with our lands registry, our land use authority, and the district authorities and the Ghana Revenue Authority. They've come out with a software which allows all of these people to link on it and then come out with various things. So GRA, Ghana Revenue Authority, we use it for rent taxes. The local authorities, we use it for property rates. We don't have what we call a property tax system, but we have the property rating system, which we use. So it's not on all, for example, we don't tax bare land, but then the properties on the land with what we charge the rates on. So those are a few of the things. And so these are some of the things we are looking at. As I said, on the international front, the minimum chargeable income is an interesting concept, which we've been discussing since 2018, actually. And we are not looking at it only on the international level, we are looking at it even locally, where there are companies that seem to be making losses continually, yet they still stay in existence. It means there's some money that they are making, which there's some tax, probably some tax on it, just some tax planning that is helping them not to pay any taxes. So in a nutshell, for the motor taxes, the green taxes, again, it was mentioned that if we looked at the rate, Ghana, we already have something which is quite high. So we are not looking at motor, but we are looking at other environmental taxes. We have a tax on plastics currently. Some of those things are still under review. So a few of these things are things we've looked at and we hope to continue looking at. As I said, I've addressed the challenges in what we are doing. So instead of listing the challenges, what we are doing is to meet those challenges that we are facing. Thank you.
Thank you very much, Dan. And thank you to all the panelists. There are lots of really interesting comments there, and it's good to hear what are some of the things that are going on in your countries in terms of responding to the current situation through tax policy proposals. And some of the things, it sounds like some of the options that Ross and others mentioned are actually being picked up currently, although, you know, with a number of challenges. It seems like all the countries that you've mentioned are looking at tax exemptions, the green taxes, or different types of environmental taxes seem to be an interesting area that all three of the countries are considering. And then obviously looking at the kind of technical solutions around improving performance of the property taxes and things like that. We have a few minutes left for questions, although I don't see questions in the chat. But there are a couple of questions that I'd be interested to hear from the panel. I mean, one is whether you think anything has actually changed permanently, or at least you know, over the medium term after COVID, that might mean that policy proposals that were previously very difficult to implement may now be somewhat easier. So I don't know whether that is, whether you're seeing any changes in public opinion about certain policy areas like environmental tax or taxing the rich, or other impacts perhaps on particular sectors that might affect revenues in the future. So I just wanted to pose that question to all of the members, if you want to quickly respond to that, starting with Walela.
It may not be necessarily due to COVID, but one thing which has recently happened in Ethiopia is the centralization of exemptions approval at the Ministry of Finance. You know, before May 2021, there were, I think, over 30 government institutions approving, you know, multiple types of tax exemptions. This had, you know, a lot of impact on the revenue leakage in Ethiopia. So to address this problem, the government decided to centralize the granting of, you know, tax exemptions at the Ministry of Finance. So it may not be necessarily due to COVID, but I think this is a good step ahead in terms of tapping the problem around the tax exemptions.
Thank you. The same question to Dennis, whether you think anything has changed that may change the type of policy that you can potentially implement in Rwanda?
No, I think you're right. I think the COVID has actually led to a lot of, I think it has accelerated the certain policies to be perceived as acceptable at the moment. I remember when we were looking at the, so when you look at the policies that we are looking at now are more of trying to foster economic recovery. And there's general perception that, you know what, if we are going to do, let's now to try and tackle, try to address these particular players who have not been in the tax base. And when the general consensus is around these who have it, because they seem to have resilience to overcome some of the pandemic. So there's a general belief in shift towards from the low income earners or the highly vulnerable groups to the high income earners. So there's always a talk of how do we now maximize, or how do we at least strengthen the taxation around the high net worth individuals, and not necessarily bring up new tax policy measures like rates or anything, but how do you use even existing legal framework to tap into these particular people. Even administratively, again, there's COVID, I think, has accelerated the acceptance or implementation of measures like appreciation of electronic means as a mode of taxation, as a means of easing taxation. People were taking it a bit slow in appreciating the effects of technology. So, but now with COVID, at least there's a general perception that there's no turning back. And as a tax administration, this is also a pressure that we have to make right on technology to simplify the whole concept of taxation and payment and everything around compliance using technology.
Thank you. And the same question to Dan. Do you have anything to add to that from a Ghana perspective?
Yes, what's actually happened is we've moved more towards electronic taxation, let me put that way. For example, just this year, just last month actually, Ghana has moved to basically a cashless office, where right now you make a tax payment, you don't go to a tax office to make a payment, you either go to the bank and make the payment, or there's a payment platform called the eGov platform on which you make the payment. So it's more of an acceleration of some of these things in terms of using digital means. We've been playing around with taxing people, electronic commerce, even domestically. But right now with COVID, more people are doing more electronic transactions. So it's also propelled us to move faster in that direction. When it comes to tax expenditures, there's been the issue of ODA exemptions, in terms of exemptions with official development assistance. It's been on the table. We've been looking at how to, but we're moving more to engage on it, because the Addis Tax Initiative and the resolution supporting, the UN resolution supporting it, which was signed by, which was unanimously accepted, indicates that the donor partners have agreed that they will not ask for exemptions in relation to ODA. The Article 58 of the resolution is very clear, both VAT and exemptions. So we are pushing that they agree to the resolution. So it needs to be implemented, so that at least it will help us with those tax expenditures. But then the income that we would lose can now come in, and we can use it to shore up our revenues. So these are a few of the things that COVID has brought to the fore. They were there, but it just made them a bit more pronounced.
Great,
Thank you.
Thank you very much to all of you for your useful insights. I would love to continue this interesting discussion, but I think it doesn't seem that we have any more questions in the chat, and we're actually out of time, unfortunately. So we'll need to wrap up now. I'm sorry for anyone who didn't get a response to your questions, but please, we hope to continue the conversation via our LinkedIn page. I think the links are just coming up in the chat now, and to our website as well. So you can follow us on LinkedIn and look at our website to get updates on everything that TaxDev is doing and our publications. We will be publishing papers from today's presentation shortly, so keep an eye out on the LinkedIn page and the website for those. And we'll be posting a video of today's event via YouTube for anyone who wants to catch up and look in more detail, or anyone who missed it to watch later. So just to conclude, I really want to thank all the presenters, the panelists, and all of participants today who've joined for all your thoughtful insights and questions. I'd like to thank our funding partners at the UK FCDO for their continued support to TaxDev. And we hope to see everyone in a future event like this very soon. We do have another event which is going to be hosted by the World Bank at the end of September, in which we'll be discussing a range of novel tax measures for developing countries, and we hope to see you there very soon. So for now, I'd just like to wish you all a good day or evening, depending on which part of the world you're in. And thanks again, everyone, and goodbye.